me hit start, see what it does. All right, it started. All right, you guys can see my screen, I'm assuming. A pinch play. Most of y'all may have at some point while you're trading heard someone mention that. May have said, hey, that's a pinch play, or it looks like it's going to pinch. There's not such a thing as that. I'll show you why here in a minute. In another forum that I moderate, there's a couple people in there. One of them's really bad. He sees falling knives as potential pinch plays, which they eventually are, but they also have to develop that position before they actually become pinch plays. They're a technical setup is what they are. There's some parameters that have to be met and some criteria that has to be met in order for a pinch play to be a pinch play. Like I said, some of y'all in here most of y'all may have heard the term at one point, but I would be willing to bet there's probably less than 2 in this room, especially only 47, that could actually sit down and explain to another person what a pinch play is. So what I did, I know the room is constantly asking, hey, can we find some swing trades? Can we find some stuff that we can be in a little longer because we're at work, we're home with kids or whatever it is, and for some reason or another you can't sit in the room like several do and just scalp these plays, and be in 1 minute and 3 minute plays, and especially with futures. So I kind of went on a mission to try to fill that void for the room. I told Lloyd I would quite a while ago, and see if I could come up with some different types of things that would lend themselves to more of a swing trade position. As you guys will notice, recently we've been getting more people that are saying, hey, what does the room offer for people that want to play just common underlying stock shares? They don't necessarily want to always play options. So I kind of took that and said, okay, let me think of something we can do that those types of members can get involved in and not have to be trading options on the short term and scalping during the day, or even on a longer term, because we all know how that's kind of going right now. If you start to try to swing trade these options, they're brutal. The premiums have been inflated so much in the last few weeks. The spreads are horrible. It's difficult to make these trades work in options. So again, I decided, okay, let me come up with something new. We did the open. We do the open interest plays, the open interest imbalances. I did a video on it. You guys can watch. I'm a little disappointed with it. It was a working thing, like anything in the stock market. Something that works, you have to find it, and typically it has a short lifespan in the market, because when you get something that works, anything that works for retail traders, whether it's a good chart setup or a strategy of some sort that you come up with. I mean, a lot of the things that I come up with are relatively new processes that the retail traders can use. However, they don't have a really long lifespan. And we were doing a lot with open interest imbalances and doing really well with them when we first started, and then they slowly kind of took that away from us. So now we're in a position where I still have the same scanner that finds them, but they're not cleaning them up like they used to. They're not protecting what we would consider to be in the best interest of a market maker to flatten those out or clean that up. For a long time, a year ago, you could use some of these max pain sites. They're called max pain, and when the max pain was defined, they did all the math. I used to do it manually before those sites came out. I'd crunch all the numbers in my calculator and give it to the rooms and say, here's the max pain on SPY or whatever. It was a lot of work to do that, but it actually worked back then. Then the max pain sites came out and made it quite simple for everybody. So they changed the way the processes are done again, so that doesn't work anymore, because it made it too simple to make money. And so then the next step was the open interest imbalances and stuff, and I wrote a scanner that actually finds those and does all the work, and those worked for a while, but now they're not working, and I haven't quite figured totally. I haven't wrapped my hands around it yet what they're doing, but I got an idea because I've watched a couple stocks that had some huge open interest. A good example is MU Micron. Had some huge open interest imbalances last week, and we tried to play that thing 2 weeks in a row to the upside and couldn't get it to work. And last week it had a ton of open interest in the options, and it still didn't work. However, if you look at it this week, it's flying up. I mean, it's been up like 6, 7, 8. I don't have the chart open, but it's been up like 6 or 7, maybe 8 days in a row. And they're big up days. It went from like $9.50 to like $11.50. So I commented in the room the other night, kind of made a joke and said, I guess I figured out what they're doing is the big money is responsible for those open interest contracts, and they're getting little IOU notes from the market makers, and the market makers are telling them, hey, just hang tight. Here's your little IOU notice, and we'll take care of you next week, because all the retail traders that are trying to play the open interest imbalances are on board right now, so we don't want them to win. So we'll let it win next week, and we'll run the stock. And best I can tell, a stock with that kind of volume is what they have to be doing. They're somehow picking up the pace where they're balancing their long and short positions, and I guess they wait till the next week or the second week. I don't know, because I have had some people come into the room and say, hey, I took an open interest imbalance that you gave us, and it didn't work last week when you gave it, but it worked really good this week. I've even had some members tell me 2 weeks later, hey, an open interest play that you gave just moved sideways and it got stuck in a pattern and wouldn't go, but I played it out 2 weeks rather than that week, and now it's working like a charm. So with that thought process going, I put together a different package for y'all here, and I've done a class on this before. However, it was a class where I had to walk through painstaking details on how to set it up, and Thinkorswim has made that much simpler these days. So what I did is I spent the last couple days writing the scanner with a friend of mine. He's a buddy of mine. His screen name is Smiley. He actually came to me a few days ago, and said, hey, Moto and Skype, we're friends, good friends. He's one of my better trading buddies. We've been friends forever in these forums and on Skype. And he said, hey, Moto, I got this pinch play scanner that I wrote. I want you to check it out. So I looked at it, and he actually did really good, because it's hard to find people that can actually write decent stuff in Thinkorswim. The tools are all there, the resources are there, but a lot of people don't really know how to use them. And even though I did a class on how to set up charts and how to set up scanners, you still have to be able to understand what criteria you need met, and then define the lines that meet that. And that's the difficult part, unless you understand how to use Thinkorswim relatively good. And he's learned it from being around me for so long by now, and he's actually done really good. I complimented the other night. I said, oh, this is a good job you did on this one. So he gave it to me, but he said, let's tweak it a little bit, because he said we don't want it throwing early signals or being late. So that was a great invitation for me, because I love doing that kind of stuff. So he kind of did the base work for me, and then gave it to me to tweak to get it to give us the right signals on when to enter these things. Okay, like I said, they're a technical setup, okay? When you see someone say in the room, going forward here, we'll jump forward, if you see someone say, hey, this one looks like it's going to pinch, there's not such a thing as going to pinch. It's either pinch or it's not. I can't even make the comparison saying, you're almost a girl. Well, you're either a girl or you're a guy, but lately here with what's in the news, that's questionable on this other stuff. But anyway, there's not an almost a pinch. It's either a pinch or it's not. Like I said, it's a technical setup, and once it develops and sets itself up, then it becomes a pinch play. What it is, if you'll look at my screen on the white thing, I did this a little bit different. I've got a pinch play set up in stock charts, and I've gotten so used to looking at it that I decided I have to mimic it in Thinkorswim, because I want to see the exact same thing. What you guys are seeing here is my exact copy of what Thinkorswim can produce, what stock charts can produce on this white version here in Thinkorswim. What I did first is I wrote the scanner, I tweaked the scanner that I was given, and defined some of the stuff a little tighter, and then played around with it to get it to give me good signals, give me late signals, give me early signals, and then I found the common ground in between. Way back in the day, Thinkorswim had a program called Strategy Desk, and I actually wrote a pinch play scanner in that strategy desk. Back then you had to write the formulas. You actually had to write it, the code. And I did that years and years ago, and it was a really good one. So what I had to do is try to copy that in Thinkorswim now with much more current resources available to us. The tools are all there. You got to know how to put them together, and that's kind of the tricky part sometimes. So what I did is I already put it together on the scanner, and I already put it together on the Marketwatch, and I already put it together on the chart. And when we get done here, I'm going to share all those links with you guys in the room, and we'll go through how to do it. All you're going to have to do it if you have Thinkorswim that you use is just launch those links and save them, and then you'll have the same stuff that I use for pinch plays without having to do all the work that goes into how to develop the programs that make it actually show up like this. Okay, I want you guys to look at y'all with me yet? You falling asleep? Everybody's awake still? I want you to look at the. I didn't even get a yes. Jeez. Okay. All right. Look at the chart that I got showing here. This white chart. On the top part, what I have here. Let me tell you where the word pinch comes up first. If you look at where I'm circling right here, you see the two black lines? When this black line on the bottom and the black line up above it come together like you see here, that is what gave this thing the name pinch. That's where that comes from, okay? The top one is a MACD, then the one under it is an ADX. It's a Wilder's, W-I-L-D-E-R-S is the name of it. It's a Wilder's indicator that has a plus and a minus factor, and I'll show you what that all means. But when you put the two of them together, they create these two black lines that squeeze together like this, and that's called the pinch, okay? Well, a stock can pinch for a long time, and it doesn't necessarily have to come out of the pinch. So when you see people say, hey, you know, this one's pinch is about to pinch, an about to pinch can cost you a lot of money because it can go for a long time in an about to pinch mode. If you watch videos on YouTube, other videos of pinch play setups and stuff, you're going to see a lot of them use the PPO. It's the price percent oscillator. That's their top portion of a pinched play. Most people don't realize that most retailers are familiar with a MACD. They understand what that is, and most don't realize that a MACD and a percent price oscillator, which is your PPO if you look on stock charts, are almost they're identical to each other. They both have histogram blocks underneath, and they both have the two lines on them, and they mimic each other nearly 100%. So I use the MACD because people can relate to it if I'm talking about it and giving a class. If you say, hey, put the PPO up there, they don't know what you're talking about. And they go on a hunting mission to try to figure out what a PPO is and add it. So it makes it real simple by using a MACD because it's the exact same thing. All right, so what I have here is there's a MACD on here, and I even went so far as to get you the link. I'm going to start putting this stuff in the room here. Here's a link on a MACD. If you guys want to take the time, if you don't know what a MACD is, it's moving average, convergence, divergent. It's calculated by subtracting the 26-day from the 12-day, and the signal line is a 9-day. So you'll see, oftentimes when you look at charts, you're going to see a 12, 26, 9. That's the moving averages that are used on a MACD. I don't want to get off on explaining the indicators, but I just want to give you a link so that you do understand it and can read up on it. I do have the standard settings on this MACD. I'll click on that. The standard MACD settings of 12, 26, 9, simple moving average, I have those. As far as the colors, I like the red and blacks because I've just used it for so long that I'm used to it. So if you'll look at this one, the MACD is down here. So one of the first criteria I had to write into the scanner was that I want the MACD to be a negative number, under 0. As you can see, it's under the 0 line here. It has histogram blocks, which are these blue things. Those are called histogram blocks. They're underneath the 0 line. Okay, we want to start off in negative territory, and then in the scanner, we want to have it become progressive. We want to go from negative to start going positive to some degree. All right. Then underneath that is the indicator called ADX, which I have that one also. It was made by a guy named J. Wells Wilder. I'm going to give you that link also. There is the ADX. That is a directional movement indicator, DMI. Average directional index is what the ADX stands for. Okay. there's two values to it. There's a signal value that goes is the middle one, and then there is what's called a DI plus and a DI minus. The DI plus is the directional index or directional index positive and directional index negative. On the chart that you're looking at, I have the green line is the D plus, because most of you guys can associate plus with things moving forward, going up, positive, whatever, and we usually see that as a green thing, okay? The DI minus, which is your directional index negative or minus, is the red line here, okay? So those two become important on what's going on here. I'll show you why here in a second. Underneath that, I have what's called a slow stochastics, okay? That is set for an 8, 20, 14, 4. 8 would be considered overbought, 20 would be considered oversold, okay? And the 14 to 4 are the moving averages that it's running on. I'll show you why that one's important. And then I've got my little ghost RSI down here, which is not totally as ghost on this one because I've actually got the internals on it a slightly light gray because I wanted to see where it is and when it's actually going to move into overbought or oversold territory, because it's actually important on these things for that to track correctly. All right. Any questions on that part? Do you guys understand how this stuff got its name pinch? It's these two black lines, the lower line on the MACD and the upper black line on the ADX. When they start to come close together like that, that creates what's called the pinch. All right, let's move up to the top here. All right, there's only a few things on the top here. What the green lines are is that is a set of what's called Bollinger Bands. And again, you guys can go to Investopedia and see what this stuff is. There's two standard deviations out is what it is. You got a top Bollinger Band and you have a bottom Bollinger Band. Those are your green lines. The center line is a dotted line. That's called the means when it comes to the Bollinger Bands. In theory, what it is it is a 20-day moving average, okay? The blue and the red line, that's what is called the blue one is called a 8 moving average, and the red one is called a 4 moving average, okay? And you guys that have been around a while know that you look for crossovers in moving averages. Longer term traders are looking for a 20-day to cross above a 50. They're looking for what's called a golden cross, where a lot of people misunderstand it. They think that it's a 50-day crossing a 200-day, and that's actually called a bullish cross. And the 50-day crossing a 100-day is what's called a golden cross. So if you're a longer-term investor, I feel sorry for you right now, but that's what that is a 50 crossing 100. A momentum trader uses a little bit quicker moving averages. They shorten them up so that they can get popular ones are a 4-8, a 4-8 cross. Some people use a 5-10, some use a 13-21. While they're all much quicker than a 50 moving day cross and a 100, they're all considered, the shorter time frames are considered momentum moving averages. So when you hear someone say, I put that, when you read in the room, somebody says, I put that on a momentum chart, what they're talking to, if they know what they're doing, is what they're talking about, excuse me, is if they know what they're doing is they've changed their moving averages to either a 4-8 cross or a 5-10 or a 13-21 or something in those areas, okay? What I have here is a 4-8 cross. That's going to be a really good momentum indicator as far as getting a cross going there, okay? So all you see on this chart on the top here is white candles, red candles, a 20-day dotted line in the middle here, which is the center portion of the Bollinger Bands, and then a 4 moving average and an 8 moving average. Okay, so that's all great. That looks good, but what does it do? Okay, here's a few things that we're looking for, and this is where the scanner came in place. There's a couple things that have to be met for the technical setup of a pinch play to be in place. If you'll notice, this stock had a lot of down days. It kind of fell out. Okay, that's a typical scenario for a pinch play. 99% of them that you see, you will see that the stock either just went down for a long period of time or it actually gapped down If I click on some of my other ones here, you'll see it's very common in a gap down also. Okay, so in a gap down situation or in a downward bearish trend like this one had, this is STKL, you get people in the forums that are doing one of two things. They're trying to either catch a falling knife, three things actually, catch a falling knife, so they just you know, they look at a stock and they say, this has to be the bottom. It can't go any lower than this. Don't kid yourself. Walter Energy went from 60 bucks to bankruptcy. BTU, Peabody Energy, went from 60 bucks to bankruptcy. So don't kid yourself that this has to be a bottom. These stocks can go from VRX $260 down to 25 bucks. So don't kid yourself, and don't endure the pain involved in trying to catch a falling knife, call a correct bottom, or call what you'll hear also a term called dead cat bounce. You'll see some people that see a little bit of encouragement come into a stock and it gets a white candle all of a sudden after it's died for, you know, a month like this one, and they're either trying to catch a bottom, you know, call a bottom on it, or, you know, feel like they're not catching the falling knife anymore, or you'll start to see the term, hey, this one's getting a dead cat bounce. All of those things can only be, you know, they can still only be good for less than a day, and they don't mean anything. You know, it could be just a little bit of exhaustion, you know, on the thing going down so much that there's some shorts covering, or who knows what's going on, you know. But you get a little bounce candle, and all of a sudden they start blowing up the room saying, hey, check out STKL, it's got a dead cat bounce going, okay? So you can play into that stuff, and it's prevalent on iHub. You know, they all got it all figured out there. I haven't been there in a long time, but back when I used to check it out, they have it all figured out. They can find the bottoms, they're finding the tops, they're doing it all. Well, here's what a pinch play is looking for. As you can see on this thing, we got the pinch. The two black lines came together. That's the first critical thing, okay? The second critical thing is you want to see that it has actually fallen down for a considerable amount of time, whether it's a week or 2 weeks, or in this case it was almost a month. If you look at it on a regular chart, you're going to see it probably looks pretty horrible. The 50s crossed below the 100. The 20s probably below both of them. It hasn't had any kind of relief, you know, from dying like it has. It just hasn't gotten any relief. And you'll often see that a lot of these things will move sideways for a while. They'll die for a while, then they'll move sideways, and everybody will come to the table and say, hey, it's been consolidating. You know, it died, now it's consolidating, and the first time they see a white candle, it's on. You know, get in. Well, don't get in, because it doesn't mean anything. You know, that first white candle doesn't mean a whole lot. So what I'm looking for on this pinch chart here is a few things to happen. I want to see that it either gap down or it's dropped down for a considerable length of time. Does that mean it's a great stock if it starts to go up? Well, technically no. But one thing that does come into play if you want to take the time on a pinch play is if you want to take the time to look at fundamentals. Some people say fundamentals don't mean anything. Well, you'd like to think that if a company has really good fundamentals that they wouldn't die like this to begin with. But we see it every day. Apple went from 130 bucks down to $89 in a short time frame, and they got as good of fundamentals as anybody. So that's not necessarily true. However, if a company like Apple has good fundamentals, what does that do for you? You know, a lot of these companies that you're going to see that show up here on my pinch chart setup don't have good fundamentals. So you got to play that into the equation. That what's going on here may be short-lived. Okay, don't fall in love with the stock. Say, okay, it's finally fixing itself. It's now a good company, because that's not necessarily true. But it also doesn't mean that bad companies with bad fundamentals can't go up. We all know that's not true. You know, Chesapeake's a perfect example. It died down to $1.50, and now it's up about $3 or $4 again. So junk companies can still go up. So what you want to see here is if you go down to the second one from the bottom, that's the slow stochastic. What I want to see there is I want to see that black line cross the red line. Now, when I had to manually do this and find these things on my own before we got the luxury of having software packages available to us like this, I had to go find this kind of stuff. Now I've written it into this program, so you're not going to have to find it. But I still want you guys to understand the 4 or 5 things that are really important for a pinch to work. One thing I was about to get to is, like I said, on the fundamentals, if the company fundamentally is good, look at why it did what this one did. We'll just assume this company has good fundamentals. I haven't looked at it because I don't care. STKL. Let's assume they have good fundamentals. So the first thing you can look for is you can say, okay, was the month that this thing dropped, is it unwarranted? Did they deserve that? Then you go find the news. Find the news of what made it actually drop. Now, this is if you want to play these things on a little longer time frame. You can look at these stocks and say, okay, this STKL, I'm just saying this matter of fact. If you look them up and say they got great fundamentals, you can come back and say, okay, this thing took a haircut that was unwarranted. They didn't deserve it. So if I get in this thing when it finally pinches, I'm going to play it until the pinch fails. But then if it continues, I'm going to get back in it again because I like the company. And I'm saying this matter of factly. I like the company, and the company has good fundamentals. So from that standpoint, there's a chance that these things can have a little bit longer life to them, even though they've gapped down or had a long downtrend. So the first thing, if you want to take the time, you can look at the fundamentals. I don't, because I trade these things based on the technical setup that it gives me, and I don't care about going long in them or investing in the companies. I know when to get out. Next thing that's really important here, if you'll look at this one, look at the volume that came in. You see this big black long bar here? You can see that this thing had huge volume come into it today. Dollar-wise, I don't know what it was. It looked like it was about 2.8 million. So from the volume standpoint on the bars here, you can see that this one had a ton of volume come into it relative to what it's used to for several months. That's a real important thing here. You want to see that buying interest actually came in, because if it throws a white candle and it's still got a little old, 1/8 inch tall black bar, then that tells you it's moving on something other than true volume coming into it and adding value. So that's the first thing. You want to see it come in with some volume, or the second thing, you want to see it come in with some volume. You see the pinch going on here. You want to see the histogram block starting to get smaller. On the very bottom one, slow stochastics, or the second one from the bottom, you want to see the black line crossed above the red line. Okay? And technically, if you really want it to be a decent pinch that's a little more sound, there's a low level and a high level. The high level, which would be overbought, would be 80 on any of the stochastics, and the low level would be 20. Ultimately, you want to see it cross, the black line cross above that 20 level low line. Okay, that means that the trend is potentially changing. But keep in mind, we're not looking for it to be a long-term trend. We just want to see that the trend is changing. Now, next important thing, real important thing here is this ADX, okay? The thing you want to see is you want to see that green line. That is your the directional index, the positive side. So it's called if you see someone saying, hey, the DI plus is turned up, what they're talking about here is on the ADX, the directional indicator has moved itself up, the positive one. So we want to see that green line turning up. So you want to see recapping it real quick, you want to see the black line cross the red on the stochastics and be above the 20 line. You want to see the D plus on the ADX, the green line turned up. You want to see increased volume come in, and you want to see the 4 moving average making an attempt on a momentum status to be crossing the 8, which is the blue one. If all of that lines up, then as a pinch play, it has potential. Okay? Here's the catch. These things are beating up stocks. They've either been going down for a month or two, going down for 2 weeks, or the gap down. So in the big picture, they're not strong stocks. Okay, so in most cases, for these things to follow through with any decent value the next day, it's nice if the market is green. I'm not going to say it has to be, but if it's a green market, in most cases, if these things are going to follow through with a pinch, they will follow through with a green market. Because the stocks are already beaten up, they're not likely to continue as a pinch if we have a big red market the next day. you're going to see they just don't work. They don't fight a broken market. It just doesn't happen. All right, now, probably the most important thing I'm going to tell you on all this stuff is next. That dotted green line is a 20-day. That 20-day, why it is determined, who determined it, why it actually happens, which market maker is in charge of it, we don't know any of that. But we do know, and this is one of those things that's at this point is a known, that if too many people get on board, the market makers are probably going to change this also. But typically on a pinch play, they fail at the 20-day. Not sure why. Nobody's really determined why. But it's very common that if you see a pinch play, it fails itself at the 20-day. Now, they will sometimes be done. Remember, it's a junky stock to begin with, junky company, unless you look at the fundamentals and it's a sound company. Most of them are junky. They've been going down for a while. If it goes to the 20-day and fails and goes down, it's probably going to go down and go hit a new lower low. If it moves sideways, sometimes they can bust up through the 20-day and go on up. And in most cases, the 50-day is going to be above the 20 when they get this far down. And I can tell you that without even having to look. And then they may take a shot at the 50-day. But a lot of that's going to have to do with whether it's even a decent company. But very important that you know you have the black line to be at. All that, I've already done all that for you. When I share you the link on this stuff, you're going to have exactly what you're seeing here. All you have to do is launch it in Thinkorswim, and all your homework's done. It'll find these for you. So real important that you understand that the 20-day moving average is the known fail point for pinches. That's where almost all of them fail, at least the first time. Okay? Well, what does that offer up for you? I'll show you. Let me give you a couple of them here. I'm going to share this. I'm going to give you guys the link for the scanner. I already did that homework for you. What I did, and I won't bore you with all the stuff, but I got 100,000 volume. That's not going to produce results that every single one of them is going to lend itself to playing options. But I know you guys, a lot of you guys have said, hey, I want to play stocks. I want to play common shares. 100,000 in volume, if you'll look at my scanner here, is not going to find stuff that's going to be conducive to playing options, because if it even has options, the spreads are going to be miserably horrible to try to play. I put a net change in there of a penny. Stock has to go up. Okay? It cannot produce me a result unless it's gone up. If that's just a penny, that's fine. And then without boring you here, I refined all these ADX, MACD, RSI, 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 and another MACD. In a nutshell, what I've done there is I've made them what's called progressive, to where they are progressively getting themselves better. And once this has been accomplished, they now show up in a pinch scanner, which I can run this one real quick. And all of these stocks will have already met, whatever shows up here will have already met the criteria that I just explained to you guys. But I want you to understand what they're actually meeting. I'm not going to bore you with going through each one of these lines, but I wrote these lines in here in this scanner, and it now produces results that will show up correctly on this chart for you. Okay? Now, let me go through a couple of them. There's a few known things that we know here. We know what we're looking for. We know where it's going to fail. I'm going to go back here. So what I did next is I created what's called a static market watch. Anytime you develop a scanner in Thinkorswim, it can then be used as what's called, and I've explained this before, a dynamic market watch. So when you click on your Market Watch tab and then set it for that particular scanner, it becomes dynamic. As stuff comes into that scanner that meets the criteria that you've written, they will show up on that Market Watch. Pretty cool feature. However, I wanted to have what's called a static Market Watch, that I can actually take the results that it's giving me and put them into a static Market Watch. And if you look on the far left, I called it a pinch play. What that is, it's a market watch that's allowing me to watch plays that play out, that come in each day, and then go out of being a pinch play. Then I add them to, all I have to do is when the scanner produces results, I just have to drag them across to this Marketwatch. That's all you're going to have to do also. I drag them across to the Marketwatch, and then they become they sit in there while they show their trading and what they're doing and what's going on. They aren't actually being populated anymore at that point. There's nothing generating from a met criteria related anymore at that point. There's nothing generating from a met criteria to make those show up. They're there, they're static. Okay, so I'm adding and subtracting from that list is what I'm doing. Okay, and I run the scanner, throughout the day, and I see what it produces in new ones, and if it goes from six of them to 12 of them, it's kind of hard to figure out which ones they are. All you have to do is drag them across over to the Marketwatch, drag all of them, and the ones that are already there, it's not going to duplicate, so your new ones will get added. And then you can click on the top one, and you can real quickly go through all of them and see how they look on the chart. If you guys know my regular Thinkorswim stuff, it's all synced together with different types of charts that I use and all kinds of different stuff. Hang on a second, I don't want to lose that. And it's synced together with this little red box. So my daily stuff that I'm doing is all synced together with the little red boxes that you'll see here. I'm going to put a circle around it. For the pinch play stuff, because I wrote a chart that lends itself to just pinch setups, and I wrote scanners that lend itself to pinch setups. What I did is I made this Marketwatch, and the pinch setups, I changed the color to yellow. So this synchronizes the pinch scanner, the pinch Marketwatch, and the pinch chart together, but it doesn't interfere with all the other stuff that I have going on, because I got several monitors, and I can have a lot of stuff open at one time. So in the backdrop on one or two of the monitors, I can be watching what's going on with the pinch stuff, and I've got it synchronized in yellow. If you guys can see what I'm talking about here, it has a little yellow box next to where you type the ticker in with a 2 in it. That synchronizes this chart with my Marketwatch scanner and all the stuff that's related to pinch plays. But if I click on one, it only changes it on the chart. It doesn't change it on all my other stuff that's going on. So again, you'll want to do that. I don't know if it'll default you to this kind of stuff, but when we get done here, you guys I'll show you how to do that real quickly so you can tie this stuff together. Let me run the scanner again real quick for today, and we'll see what it comes up with. Again, I'm going to share this with you. Here's what it's got. I'm pretty sure I already moved all these over. Let me look real quick. I have. So like all I'd have to do is I'd take this little Marketwatch over here, and this scanner produced these results. These are results that are pinch plays for today. Some of these may have come in early this morning. This is all being recorded, Gigi, so when we're all done here, we'll get this video going. We didn't really plan for this, so I am recording it, so you'll be able to watch the video. All right, so all I have to do is take this ATI, slide it over, BKE, slide it over, CH. They're all of them are already in there because I did this earlier today. So all I have to do is take the results that come in from the scanner and slip them over into my static Marketwatch. Now, then I move the Marketwatch off to the top of my page, and I start at the top, click on the first one, and I look at it, okay? Now, this Marketwatch that I have also has tickers in there from yesterday, okay, because I started doing this a couple days ago, actually a few days ago. So not all of these tickers are ones from today. Some of them are from yesterday. So one like this that I'm looking at, ALK, as you can see, it pinched, and it threw a wick that almost touched that 20-day, and that was it. So at this point on this particular one, I wouldn't do anything with it, okay, because the green line is not turned up. This one showed up yesterday, and when I get to the point where I show you my IB simulator and the spreadsheet that I made you guys, you'll see that I actually took this one. What I did is, over the years, I've always played pinch plays by looking at the chart and saying, okay, this one looks like it's going to pinch. I want to take this. There's a characteristic that used to be pretty solid with pinch plays. When they open the next day and if they're going to pinch, they don't drop a wick. That's an interesting factor. However, it's not 100% solid as it used to be. wasn't that long ago on a pinch play, if you had a chart set up like I have here and could find them, when they opened the next day, they rarely threw a wick. And because of that, I did this class a couple years ago in another room that I moderated, and there was a guy in there, and Donnie knows him in here, that I taught this stuff to, and he played, all he did was play pinch plays, and I think he still does. But he knew back then that he didn't want to try to find one that looked like it worked if he had a list of 6 or 10 of them. He didn't want to say, okay, I like this one the best, and he'd pick one because if it failed, then you lost interest quickly. So what he did is he would play 6 or 8 of the 10, or maybe all 10, because typically in the past, and I haven't really checked to see if that's still consistent, they would open the next day and they would not drop a wick. So he could safely get into all these pinches at the end of a day, and the next morning he could put a 2% stop on them, and the ones that were not going to work stopped him out with a 2% loss, and the ones that were going to work would run and go. And because they didn't wick down the next morning, that was a really pretty bulletproof system, because he could put 6 or 8 of them on with a 2% stop loss, and if it wicked him out, they weren't going to work anyway. If the ones that worked, they usually were good runners, and over a couple year time frame, he would get way more winners than losers by getting stopped out. I don't know how solid that still is, but let me go to the next one here. Again, some of these were yesterday, so I'm going to show you on my list here in a minute. Let me go to the ones that actually cultivated themselves today. They should look better. Let me see. That's I'm going to change my Marketwatch here real quick. Change this Marketwatch to this one right here. Here's my scanner. The scanner is going to kind of populate those ticker symbols. There's the ticker symbols for today. And now I'll start on those and see what they look like. All right. That one didn't work today. I don't remember. Do we have an upper market or down market day today? We had a down market. Okay. Like I said earlier, a lot of times these things will not fight a down market. They're weak stocks to begin with. Next one. Okay, there's one. Now, here's a company we're looking at, CHDN. I don't know anything about them. It had average volume, okay? It's got a white candle. The first thing I look for is, does it have any room to actually run to the 20-day? You know, knowing that that's probably where it's going to fail, what kind of room does it have if it does decide to go there? Well, in this particular case, it closed at $1.27 today, and in 20 days at $1.30 and 65 cents. So it's got about $3 worth of upside to it. I probably would not take this one yet because it didn't meet all the criteria. We did get a cross on the Stochastics, but I like to see a little stronger up D plus or DI plus on that thing on the ADX, and it didn't get higher volume. It got higher volume as far as from an average standpoint. So that's a positive thing, that there's more volume coming in based on comparing it to the average across the lines here, but it still didn't have the highest volume. So that's probably one I would watch, but in this particular case, I would like to see it have a little bit more room to go, so that if the next candle does come out white tomorrow and it does show increased volume, we're not so close to the 20-day that the thing's going to be over with. Go to the next one. There's one. It's turned up. That one doesn't have much for room left. If you look at this slow Stochastics, it's turned up. The D plus, that's how I like to see it right there. It actually pinched a little better back a couple weeks. And yes, it had increased volume. I guess if you can call that volume. How much is it? Less than 1 million. So here's one that, okay, most of the criteria was met. It had increased volume. It pinched. The D plus turned up. The Stochastics crossed, black crossed the red. It's above the 20 low level, and it's got a white candle. However, there's not much room from here left to go to the 20-day. So one like this isn't going to interest me much. You know, from a trading standpoint, it closed. Looks like it got to around $4.04, and the 20 days at about $4.26. That's not enough room for me to challenge one. So I'd move on past that one. This one I actually took today in my simulator. Okay. And I got in it a little earlier. This one gave us better volume, not quite as much as yesterday, and yes, there's one or two that are a little higher, but for the most part, it gave better volume than all the way across the board here for a long time. So that tells me some buying interest came in. It's got a really nice pinch. If you look at the two black lines, they're pretty tight. Okay, and then the D plus turned itself up. The green turned up good. That's a steep angle. That's a nice turn up. Okay, and then the stochastics is crossed the red, black crossed the red, and it's right at the line where it's at 22.38. So it's above the 20. So I went ahead and took this one only because, while it doesn't look like it has a lot of room left, it is 38.63 is where it was at today, closed, and the 20-day is at 39.90. So that's what, a buck or two. Let's see, yeah, about $1.50, maybe $1.52. If it throws a wick above the 20-day before it fails, it's got a couple bucks in it. Okay, so I think, I'm pretty sure, I'll look here in a minute, but I'm pretty sure I took that one. Kors, K-O-R-S. What do we got here? No, didn't make it. Wouldn't take it. L-E. Okay, here's one. I didn't take. Yes, actually, I did take this one. I took some of them today so that I could show you guys on the platform, a simulator platform, how they actually are going to work. I took this one. Volume, again, is not the highest it's had, but it's above average. It's got a really tight pinch down here, and it got the D+. I'm kind of programmed. I look at this D+ green. Oh, and what I was going to say, I meant to mention this. When I said I was testing this in the room, I can pick out ones that I like, individual one or two stocks, and play them. And I've done that for a long time, for years. And that's one way to do it. I had explained how my buddy does it, and that he picks 6 or 8 of the 10, or maybe all 10, puts them on with a 2% stop, and if he gets stopped out, that's it. What I wanted to do here is take a lot of them, 20 or 25, okay? If you've got an account that can handle it, I'm going to try to see if I can come up with test results that make this a proven theory that actually works. So what I'm trying to do here is see if across the board we can get wins out of it, and good wins, okay? So rather than have to try to handpick 1 or 2 out of the batch and say, okay, I'm going to try this one, I'll try this one, and maybe get 2 that don't work because the next day the market's red, and you're going to be going, well, that didn't work, so what do we do now? Or even pick 6 or 8 of them. I want to have, I think I've got 28 of them going, okay, that I actually picked out. I want to have a basket of these things so that I can look at a generalized result and say, okay, when you pick 1 or 2, you hit and miss. It's kind of like playing stocks or options. But if you look at the charts and you look at it from a technical standpoint and you select all of them that should potentially work, you get enough wins across the board that you're a winner doing it. And if you've got an account that will allow it, what I did on the trade IB, the interactive broker trading platform with the simulator is you don't want to set a fixed amount of shares. You want to set a fixed amount of dollars. So don't be one that says, okay, I want to buy 100 shares of each one of these, because they vary in price so much. You're going to set yourself lopsided on playing them. If you played 100 shares of a $60 one and 100 shares of a $1 one, if the $1 one works and the 61 dies, the $60 one dies, you're going to be way offset. So what I did is I said, okay, I'm going to put as close as I can to about $1,000. Use a dollar figure that's equal. I'm going to put $1,000 into each one of the plays. I'm going to set them up, and then I went in and I set the play so that a 5% stop loss. Normally I won't use stop losses, but with this type program, when I trade, I watch what's going on. I don't set stops. I know a lot of you guys have to and do. But what I did on these, because I have so many plays going, is I told myself, okay, I'm going to put 5% stops on them. If they're not going to work as a pinch play, they're going to take out the stop, and I'm out 5%. I put a 10% profit on them, okay? Most of these plays have a lifespan of 2 days and a max of about 5. So I decided that if they get to 10%, that's a pretty good return in a 2 to 5 day lifespan. And 2 to 5 days falls into the category of what you guys would want to see for swing trading stuff, and not stuff that you have to scalp every day. So what I did is I set up my interactive broker. So if any of them that I have going take a 5% drop, they're done. Sell me out of it and get it out of it. If they get a 10% increase, then sell me out and get me out of it again. And I actually had two of them sell out today. I got 11.35% on one and 10.23, I think it was, on the other. And I got that in one day. Now that doesn't sound like a ton when you, in retrospect, when you compare it to the open interest imbalance trades that we're trying to make, where we play small and win big, and you buy a 10-cent MU option, put option for for 10 cents, and you do 5 contracts, you got $50 on the table, and we hope it goes to 50 tomorrow, 50 cents. These are a little different than that. When you have 28 of them going, that's different than playing a few contracts on an open imbalance. So what I do is I preset my stop out, and I preset my profit that I take. And what I'm going to do here is I'm going to test it, and you guys can test it too, but you'll also be able to use the system to make trades on stocks as you're testing it like I am. I want to see overall across the board what the results are. I've never done it at a level of this many stocks, because I actually, if it's sound and it's pretty, I don't even want to say bulletproof. There's nothing bulletproof in the market, but if it's a decent sound strategy, I don't mind having several positions on, okay? Because it's actually pretty cool, because if you catch them right and you catch them down here where they show all the 4 or 5 technical reasons to actually go, and we get a green market the next day or even a flat market, in the perfect world, if you get one that goes when the market goes down, then you got something there. You can really take a shot at those, because they're defying what's going on around them, in that the market's dropping and the actual pinch play is working and the stock's going up. Those are really good ones. And the other cool part is we know where the known fail point is. So when I show you my list here, I'm going to show you some that I actually traded from a pinch and they worked, and then I flipped to the other side, because in 1 day or 2 days they made it to the 20-day. You're going to see some common stocks in here that you guys have been watching and playing. FSLR, First Solar, was a perfect one. I actually played it. It was an easy one off a pinch. You probably saw people say, hey, FSR, First Solar is pinching. It did, and it pinched good, and it failed right at the 20-day. So it was an easy one to take short, and I knew right exactly when to take it short. So you'll see in my portfolio thing I'm going to show you here that I've got several of them in there. There's 28, I think, and they're about maybe 40, 60. There's several of them that have hit the 20-day, which I know is probably where they're going to fail, and I got them on a short position. So obviously you can't do it in an IRA if you're going to start doing a whole bunch of shorting. And shorting is dangerous for the most part, is what people are going to tell you, because it can go against you infinitely. Well, that's not true. Find me a stock that goes up forever and doesn't go down. But keep in mind, the important thing here is we have a known fail point. So from a shorting standpoint, you get pretty good odds in your favor that they're going to fail there at least once or twice. And if that accomplishes a couple candles in a couple days for you, then you ended up with a nice short. And then you can cover the position and be done with it. So knowing that, I'm willing to take them short and challenge most of them when they get to the 20-day, because you will see that most of them work. So it's a pretty cool concept in that it allows you to play the thing long, get the correct signals on entering as a long position in a pinch form, and you know exactly where you want to bail on that thing and take it short if you choose to. So you get to play both sides, and you can usually make money doing both sides. Let me look at the next one. I don't think I took this one. I didn't take this one. I probably could have. Sound like off the GC. All right, this one probably would have been decent. The 4 is about to cross the 8. Got a decent candle, a little bit, above average volume in it. It's a nice tight pinch. The D plus is green. That's green is turned up, and the black's kind of up on the Stochastic, not above the 20. I probably would give this one another day because it has a little bit of room to the 20. It closed around 44.96. It looks, and the 20's at 47. So it's got about $3 in it. So if tomorrow it opens up and gets a little candle going, and that green D plus keeps turned up, and the slow Stochastics crosses above that 20, I'll probably put that one on in my simulator and take a shot at it on a long position, because all the stuff that you want met is being met. This one didn't take it. All right, that's the scanner. I'm going to minimize that. Go back to, where am I? Let's see. Let's switch this back real quick. Hang on. Let's see. I got a pinch play. There it is. All right, so here's my list of what I've put together in the last 2 or 3 days. These are all stocks that have pinched, and they may not necessarily be a pinch anymore, but the reason I keep them on here is if I've played them and I'm playing them long, I know when I want to get out of them. So some of these I'm actually waiting for them to hit the 20. If I played them, I'm already out. Like this one here, the CCM, look at it. It's pinching and it looks great, but it's kind of an illusion because the 4-8 has crossed. It's got 3 candles in a row that are up. So from a pinch standpoint, it looks good. You can see where the D plus green made a nice steep turn up, and it followed all 3 of those candles up. It actually crossed the D minus, which is actually a really good signal as far as bullish. And the slow stochastics is perfectly, looking perfectly set up. It's black crossing red, and it's got above the 20. So everything's perfect except one thing. Doesn't have volume to support it. So on one like this, you see how that thing moved sideways forever, and then it just died. It took about 2 weeks to get itself to die down here. A lot of people are going to see this through a rose-colored glass. They're going to see, oh, okay, it's a momentum play, the thing's changed, and blah, blah, blah. They're going to have all their reasons to get in. I don't really want to play it long. I don't know if I did or not, but from a technical standpoint, it doesn't present itself as one I would touch here. However, I would love to see this low volume take this thing up to that 20-day. Because if it gets itself to the 20-day at $4.13, this thing's probably going to be done. And all the penny players out there that are pumping this thing, and I have it all over the world saying, oh, get in CCM. It's got 3 up, 3 up candle, 3 white soldiers, and blah, blah, blah. You're going to hear all the terminology come out. And they're all playing it, but you're watching it going, okay, y'all just get on in that thing and run it on up to 20 for me so I can short it at $4.11. When it comes back down to, $3.50, and then I got a 60, 70 cent short out of you. Thank you. So one like that, I'm waiting on. Doesn't have volume to support it. This one, I didn't lose faith in it. I got in it yesterday on a long position because you can see everything was right. Slow stochastics was right. The green was turned up. Forget the little chunk on the end today. From yesterday's standpoint, it was turned up. Has a nice tight pinch. If you look at it from a volume qualifier, that little black candle, other than these 2 great big ones, it was above average for this particular stock. So the volume was above average. Everything else was met. Yesterday it looked good as a pinch, and it's at 730, and it can pinch all the way up to the 20 of 858. So the one red candle today didn't discourage me enough to get out. If it gets another one tomorrow, then the pinch is done. I'll get out of it. Okay, so, but I didn't bail on that one today yet because that one candle doesn't tell the whole story. I think we already looked at that one. Look at some of these other ones. ePay. And again, I don't know anything about most of these companies. There's some in here that you're going to recognize. There's one right there. And again, I don't know anything about most of these companies. There's some in here that you're going to recognize. There's one right there. Let's see how that did. Yeah, look at there. There's First Solar. All that will already be built in for you, Janine. When I give you the link, I've already set all the links on all this stuff, the time frames and links and all that. If that's what you're asking as far as the links of the moving average. Time frame, if you're late to getting here tonight, if you'll watch the video from the beginning, I've already defined the time frame. There's certain things that have to be met, and when those are met, then your time frame is predetermined for you. Now look at First Solar. If you look at it, it got the 4-8 cross 3 candles ago. Got a nice white candle with a wick on the top. Everybody in all the forums was talking about, hey, get in First Solar, get in First Solar. It's the stock to be in. And if you'll look back here 3 days, 3 or 4 days, we got the cross right there on the 4-8, got a white candle, and it gave us all our signals we're looking for. You see how it pinched out really nice and tight? What we're looking for is them 2 black lines to spread themselves apart. Once they pinch tight like that, we want them to open up. Okay, once they open up, then the pinch starts to work. And if you look back about 3 days, we got a perfect reading on the slow stochastic where the black was above the red, and it worked perfect. However, I didn't catch it till yesterday, but I knew it was going to fail at the 20 because most of them do. And so while you got everybody diving into First Solar, um, just because it got a little bit of life to it, it still falls in the category of, okay, it's a good company, it's a decent company, but it gapped down and then it followed through for, what, 3 weeks, 4 weeks, 3 weeks, and just died. You know, so when you get a popular name company like that dies and all of a sudden some life comes into it, everybody and their brother's diving on it, think they're playing Apple. And that's not the way it is. And as you can see, it played out perfect as a pinch here. So had you caught it 4 days ago, where the momentum crossed, your green D plus turned up, your stochastics crossed, and it pinched really nice. If you caught it right there, which this scanner would have done, that was 3 days ago, and doing this 3 days ago, you would have caught it, and I would have taken that long. But you can see exactly where you needed to get out. And that's when I took it short. I'll show you in my portfolio, I took that thing short. Right at the 20-day. And as you can see, it failed, and then today it has another down candle. Now, tomorrow, one of two things will happen. If it gives me my 10%, I don't know if one like this is going to give me my 10% in 3 days. Probably not. If it gives me my 10%, my system will automatically stop me out of that one with a profit because I'm short on it. If it dips in the morning and I see that the thing wants to recover itself and potentially continue on up past that 20, which like I told you earlier tonight, some of them do. If they're decent companies, they'll fail at the 20, they'll break down a little bit, but then they'll hit it again and go run. So if I see life come back into this thing tomorrow, but I do get a dip in the morning, I'll probably take the position and bail on it as a short. And it was a good win, you know, good play, easy play. There's another one. Look at this one, same thing. You know, so what you guys are going to start seeing here is something that a lot of people don't see. You know, they're bandwagoning on these rooms and all the encouraging stuff that's being said. You know, and I even kind of laugh sometimes when I see some of the stuff written. You know, here's GILD. You know, Gilead Sciences. Everybody in here knows of Gilead Sciences. It got its pinch signal 4 days ago. 4 days ago. My buddy in the Skype room actually took it 4 days ago along in his real account because the setup was so perfect here. If you look at it, it got that little candle, but the 4-8 crossed, okay? And it was pinching. It was a really tight pinch if you look at the two black lines. The D plus had turned up and the stochastics had turned up. 4 days ago, it was a perfect. He took it long and he did really well when he played calls on it. And even though the calls are a little pricey and the spreads kind of stink, he actually did well because he could see that it had set itself up perfect for a pinch and it had a decent amount of range to go to the 20-day. And he felt like if it made it to the 20-day within a couple days, which is normally the lifespan of these things, it was probably going to make the calls work really good, and it did. But we both knew once it hit that 20-day, it was going to fail. And if you'll look at it on my chart here, it did exactly that. So I have that one short. I knew exactly where to take it short. So in my account that you're going to see, you know, some of these things I can look at this chart and I can tell you what I know what's in that platform because they're set up for it. And I took them. You know, so it hit the 20-day and it failed. So again, here's a good company, but look, it gapped down. You know, then it died off for a few weeks. Then it set up for a pinch. All the criteria was met. Got a nice big candle. Got to the 20-day too quickly for me to play it long. My buddy caught it 4 days ago when it got that first setup, and he got it. But I knew at the 20 it was done, so I took it on the short side. And now I'm winning on it also. And he knew exactly when to get out. Didn't get that one. Let's see what else we got here. Okay, here's one right here. This thing's just about done, as you can see. This one's been on my scanner for a day or two, couple days actually. You know, you got a decent pinch on it right here 2 days ago, 3 days ago. 4 crossed 8. You guys probably can't see the line it's drawing on mine, but the stochastics was right, the D plus was right, the pinch was tight, it spread open. It got higher volume in it yesterday, so you could have taken that one and probably done pretty good with it, but it's probably done now, more than likely going to fail here at the 20. All right, so I'm not going to bore you all with going through a whole bunch of more different ones. Let me show you a couple things I did. Here's where it stands. This is Interactive Brokers simulator platform. All you care about is the center part here, okay? I'm going to click on position, and what it's going to show you here is you're going to start to see some of these tickers that we just went through. Okay, we went through STKL, we went through CFMS, we went through RBC and CYH. All those on this green side where it says POS stands for position. These are ones that I took positions on. If you look over here on about the second to the last column, you can see I made one mistake. I had a little fat finger type here. I meant to put 10 and I put 100. So you can see I've got RBC in there at $5,663. I wouldn't play one, a pinch play individually at that size. That was a fat finger 10 type into 100. So there's one big one in there. I'll probably let it do a little bit, but I'll be fair with it with the same percentages. If it does 5% down and it gets out, if it goes 10% up, I keep it and get out for profit. If you look on the position sizes here, all these green ones are long positions. They're about 12 or 15 of them, okay? And then all the bottom ones are the short positions. So as you can see, I got GILD short, IPGP short, First Solar short. You know, some of these we looked at here just tonight a little bit ago. ALK we looked at, MOH we looked at. They're in my short list here. I've got those things shorted. Okay. The reason the account is showing, I started this account, this simulator account when it was down $262. I have to use that number to start with. And the reason it was down is because of two things. I put on a SPY, Lloyd been bugging me to do a SPY call credit spread. And while I didn't really want to do it, I wanted to track it. So I put that on in here, and it's down $60. And the other night, I don't remember if it was last night or the night before, I think it was last night, when I was messing around with this stuff and trying to put them in the simulator, I put on an ES trade that actually worked. And I'd gotten like 2 or 3 Google Chrome flash crashes, and I was really frustrated. And I got tired of it. And I had on an ES short at 2083.95, and I got a flash crash, and I was ticked off. So I said, the heck with this. I'm tired of it. I'm not messing with it anymore. So I didn't reboot everything, restart everything. Well, when I opened up this morning, I had forgotten that I had left on a short position in ES on the simulator. So of that 336 negative it shows here, 225 of it and 60 of it account for the ES trade and the SPY trade that I left out by mistake. Well, because I didn't feel like coming back in. So in a nutshell, what it amounts to is all those trades are actually up a few $100. Click on the profit loss here. So here's the profit loss on the ones that are going on. If you look at this CBR, I put it on. It's up $85. I got $1,071 in it. I bought it at $1.13, and it showed up, and it went to $1.27 today. So it's up $85, which is about 8%, 8.5%. So in the real world, yeah, like I said, when we play the open interest trades, we're trying to get 100 to 300%. But when you're playing with a little bit bigger money like this, and you're playing for positions that have a technical reason to work, and you know where your known fail points are, you have to back down a little bit and say, okay, at $85, that's 8.5% overnight. If I can consistently do that with several of these trades, that's hitting lots of singles for big home runs. I would probably take that, especially if I'm getting it overnight. If I put $1,000 into one of these and it gave me $85 the next morning, I'd take it. You know, you're not going to go broke doing that, especially trading the common shares. You know, so these next ones down, they're not there yet. They're $31 is not. Keep in mind, all these are based on about $1,000 put in. So $15, you know, it's what, 1.5%. Still not bad for overnight. You know, if you do that consistently, you're beating the hedge funds, I can assure you. On the short side, on the loss side, that's the profit side. I've got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 or 13 of them that are working. And I got to skip the ES trade. I got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 or 14 of them that are not working so far. But I did have 3 of them that I took off today that came off because of the 10% that they made. So overall, from starting yesterday, I'm actually up. I didn't look. I was down 262. If I took out this ES and SPY thing, that equates to about 300 something bucks. The whole thing since I put it on yesterday is probably up about $400. All right, so I can enter these from my ladder on Thinkers. I mean, Thinkorswim. I don't trade Thinkorswim. On Interactive Brokers. You know, so all I'm doing is I got a real quick process. I go in here like tomorrow morning when the new ones come up. I'll slide them over to my Marketwatch first, and then I'll click on them, see how they look on the chart. If they look set up from a technical standpoint correctly, I'll put them into the simulator, and I'll divide 1,000 by the share price it's trading at, and I'll buy $1,000 worth, and I'll put them on, and I'll leave them. On these long positions here that I have in here, all these long positions, let me go back to positions, all these green ones here that you see on the left side column, I'm going to wait until those get to the 20-day, unless they prove themselves differently that they don't want to continue to pinch tomorrow. Today, market wasn't down enough that it set off any signals in my mind to think, oh, I got to get out of these, because I have to trade this exactly like I will with my real money, because if I'm willing to put up 28 or 30 or 35 positions with $1,000, I'm going to have, you know, $35,000 or $40,000 invested in this. So I want to take it serious. So to play it at anything other than that in a simulator would be foolish on my part. So I'm going to watch them. If they look like they're not going to pinch anymore, then I'm going to get out of them, and I'm going to record the loss on them. If they get to the 10% and they profit out, then I'm going to record that also. I'm tracking it on a spreadsheet. So, and I'm doing this couple things. I wanted to do it for the room so you guys have something new to try out, so that you learn something new, so that you can play long common shares of stuff if you want to, and so that you can short stuff if you want to. So there was a few different things I was trying to accomplish here, but I'm also doing it for myself, because, you know, during the day I can't sit there and scalp trade all day long either. I run a company, so I got better things to do than try to scalp for 10 cents on Apple. So I'd love to actually get myself a bunch of these going and then check them in the morning and see which ones look like they're going to continue and leave them alone, and which ones look like they're at the top, you know, at the 20-day, and get out of them. Take the profit. If it wasn't 10%, still take the profit. I won't try to let it go over the 20-day to try to accumulate 10% profit. If it's at the 20-day and it's going to fail and it's done 6% on it, I'll be taking 6%. But then I'm going to probably flip it and go to a short position, which is then going to throw it down in the bottom here. I want to run this thing for a week or so, and if it proves to be really positive results, then I'm going to do it in my real account. And hopefully some of you guys will be doing it with me, because I'm going to share the links that generates all this stuff for you. So you'll be seeing the same thing I am. From a spreadsheet standpoint, here's what that looks like. All right. There was one I took. I got it listed here. Here's a spreadsheet. This is a simple spreadsheet in Microsoft Excel, and it says pinch plays. I got the date ticker, the bought or sold, number of shares, purchase or sell price, profit or loss, and percent gain. Okay, if they're red, it'll say STO, sold to open. That means I shorted them. Okay, shows as a positive money. I actually was green and I'm selling it. Okay, all these little red dates mean that I have those sold. Okay, that means I sold to open, and it's probably, if I were to go look at these things, they are probably, every single one of these is at that 20-day. I did have some that worked quick enough already that they were exited out of a profit. One of them was NIHD. Let me look at it on the chart. I'll show you guys. It's still on here. NIHD. Yeah, look at it. Okay, I got in it and timed it right yesterday on the pinch. Actually, I might have got in there. I got in that one this morning. That was a one-day trade. It gave me a perfect setup for the pinch here. Gave me the up D plus, gave me the cross on the stochastics, gave me the pinch tight, gave me huge volume compared to what it's relatively, you know, what's relative average volume is, and it gave me a big old candle. So I caught that thing, and it gave me, what did it give me? 10%. Yeah, I got $103 off that trade for 10.35%, and Interactive Broker sold me out because I set it for 10%. So that was a nice trade. Then I flipped and tried to get it to the short side. It went to 387, and I stuck it at 390. As you can see where it got stuck at that 20-day, it went to 387, and I set my short at 390 because the minute I got out after it worked for 10%, I knew it was going to fail at some point at that 20-day. So I immediately tried to set myself up short on it, and I never did get it. I actually tried to chase it a little bit. I thought, this thing's going to fail here. I'm going to get this filled. And I went from 390 down to 387, 383, and down to about 376, and I finally quit because I got tired of chasing it. But it did ultimately drop down to 350, 352 is where it went after that. So had I filled at 387, I would have caught 30 cents on the flip side of that thing to the downside because I knew it was going to fail there, and it did. So that was one that was just a one-day trade for me. And in normal circumstances, I probably wouldn't catch it because I'm busy, but because I'm working on this for the room today, I actually caught it. Here's another one. I got in this one yesterday as a short. We'll look at it on the chart here in a minute. I got in yesterday. That's why it's red, and it says STO. I sold to open at $15.38, and then I covered it today at $13.64 for $104 profit or 11.31%. Now again, if you guys are programmed to find these 100 to 300% trades, this is probably not going to work for you. But if you're one of those people that can say, hey, if I can make 10% or 11% off $1,000 by the next day or the following day after that, I'll do that all day long, especially if I can do it with 28 positions and get 90% or 80% of them to work. You start popping 10% off $1,000 on 20-something positions in 2 or 3 days and continually, consistently do that, you're going to be making some decent money. You're not going to be caring about going for the big hits. What was that one again? I wanted to look that up. Sorry about that. Oh, goodness, where'd that window go? There it is. That one, I got in yesterday, and I got out today. I covered it today. It was RUBI. Let's see what it looks like on the pink chart. RUBI. All right, that confirms my theory. Look at it. All right, perfect pinch setup. Crappy stock. It dropped, gapped down big after it went sideways for quite a while. Increased a little bit, not much. Then it gapped down, and then it went down a little bit more, and then it went sideways. Then the pinch came in. You guys got to see it if you had my setup here. You got to see the red cross the blue. You got to see a little bit of increased volume come in 3 days ago. You got to see the pinch was really tight. You got to see the D plus come up, and the stochastics was perfect. Everything was perfect. I got in that thing yesterday, and I knew exactly where to get out, as you can see. So I took that short when that wick hit the 20-day yesterday, and boom, check it out. It failed big time today. Gapped down. So that was done. I got my 10 or 11% on that thing overnight. Like I said, you do that over and over and over, you're going to start to accumulate some money in your account. It played out perfect like a pinch should. It gave me the right opportunity to get in, and it told me exactly where to get out. And I did. I got in, got out. Shorted it. All right, so where'd that list go? That pretty much, some questions. So this list that you see here, it shows the, okay, let's go to this one. Don't let me forget this one. DXPE. I got to talk about the ones that don't work too. DXPE, I got in yesterday. I bought to open at $14.93, and Interactive Brokers stopped me out today at $14.08. I think with the commissions and all that stuff involved in there, it ended up being a 5.69. I don't know how it quite got there because it's supposed to be 5%. It may have gapped down or something. That's one that didn't work. So far, I'm still batting a pretty good percentage because I got 2 that did work since yesterday. One for 103 at 10.35%, one for 104 at 11%, and one that did not work at $61 down at 5.69. I'm going to look at that one. I probably don't have it in there anymore. DXPE. I'm going to add it to Thinkorswim real quick. DXPE. And the reason I probably took it off is because it's not a play that I want to take anymore. It's in a neutral zone. So I'm not interested in it. As far as a pinch play, you can see it did exactly what it's supposed to do. It had an up candle, and then it had the big wick candle, and it touched that 20-day. I may have gotten in it too close. I don't know. I would have to look. But it did touch the 20-day, and that's too close. I don't know. I would have to look. But it did touch the 20-day, and that's the fail point. So it would have been better as a play yesterday to short it than to take it long. And no, this. Oh, I'm sorry. Thank you. DXPE. Sorry about that. Thought I clicked on the right one. There it is. Okay. Now, that makes more sense to why I played it now. If you look at it, it was a perfect setup yesterday to take. Okay, it had the Stochastics cross, black cross red. The D plus, if you look at it, was up just like we want it. The pinch was tight. The volume actually came in really nice. So it set itself up really nice for a pinch trade. Didn't give me any reason why I wouldn't want to take it, and I took it. But here's where you want to have, and you know, there's a whole gamut of reasons why it didn't work, and I don't care. I don't know if they made some announcement or if the CEO slept with the secretary. Don't care about any of that stuff. All I care about is that it technically set up right for a pinch play, and I took it as a pinch play, and it didn't work. And because I'm disciplined with a 5% stop, it stopped me out. So that's the end of that trade. So now it's neutral. I wouldn't even look at it again and try to make a determination on what I would do with it here, because as a pinch play, it's not set up correctly anymore, nor is it at the top 20-day, so I wouldn't consider shorting it right here. So it's kind of in a neutral zone of doesn't really tell you what it's going to do, so that's why it's no longer even on my watch list, and it's going again. Does that make sense to y'all? I mean, it's not a play anymore, so you're not going to get all of them to win. And when they prove to you they're not going to work, then you get out. You get out 5% loss and move on to the next one. I wanted to tell you, if you will go down in the, I want you guys to be able to watch this stuff. These are ones that I took, and I've shown you several of them. You can see my reasoning behind it, that as long plays, they made sense. As short plays, they also made sense now that you guys understand what a pinch is. So if you go down to the bottom of the forum, on the very bottom right corner, you'll see a little envelope, okay? And in that envelope, there's this document. I put this in here tonight, and it's called Pinch Plays. So when you get a chance, go down there, click on Pinch Plays. Sometimes it'll just open if you have Microsoft Excel on your computer, and sometimes it will download it as a document. Whatever URL page you got going open, it's probably going to dump it down to the bottom left of it. It's going to count off a few seconds, and then you're going to have to execute it. So you can double click on that little box that it executes down on the bottom left, and it will open that thing in if you have Microsoft Excel on your computer, which a lot of them come with it. So you have access to this document. So I can tell you this: all of these trades I made a correct entry on, as far as the what it should look like and how it should present itself from the chart setup. All of these that are short, I made a correct entry on from the 20-day, where they normally fail. So as far as why the entries are made are correct. As far as whether they work or not, you guys will actually get to see if you want to take the time. Okay? And then when this is all done, then I'll be able to look at my statistics across the board in a week, because most of these plays have a 2 to 5 day lifespan, and all of these plays will have completed themselves in the next 3 or 4 days. And we got a holiday in there, so it may be Tuesday, Wednesday before this thing completes itself. But I'll be able to cycle an entire batch of stocks that had correct entries for longs and shorts based off the chart setup, and I'll be able to analyze them probably next Tuesday and look at how many worked, how many didn't, and then consider if it's something that done on a larger scale across the board, does it pay? Does it pay us well overall? If it does, wonderful. That'd be great, because I've written the scanner to find the things for us, so the hard work's done. Does it not work? Okay, so let's say it does 50%. Let's say 50% work. Then I can look at it and say, okay, of the 50% that didn't work, what's a common denominator that we can address here and say, okay, these didn't work in why. Here's why. Maybe we can't determine why. Maybe it was some news event or something. But if there's some kind of catalyst that we can actually put our finger on, we can say, okay, this is a common denominator as to why these 10 or 12 didn't work, and here's the common denominator why these work. And if we can do that, then we can take the big picture again at the end of the testing process here and say, okay, we have to be selective, I guess, on which ones we want to play. So rather than play 28, maybe we play 12 and say, of the 12, we should get 10 winners, because we've been able to pin down, based on the first batch, which ones worked and why, and which ones did not work and why. So I got a little bit more I got to do to continue the process of getting this thing, really, really good for the room. But I made a lot of progress. We're close. And like I said, go down to the documents. You can get this document. You can keep an eye on these. Do practice. Look at the ones that I have long positions, because I can tell you I entered them right. Look at the ones that are long positions, and then look at how often they actually fail. Look at which ones get to the 20 day, and technically they do fail. And it's a really consistent thing that you see, and you say, gosh, these are great plays, because 80% of them, when they get to that 20 day, they fail. So I feel pretty safe in shorting them when they get there, or especially if they wick up above it. I'm going to take them short. So these are things that we'll be able to develop by watching these things. Last couple things I'm going to do here, I'm going to put some links into the room. This first link is going to be, I'm going to copy you guys this link. Because this is recorded, these links will show up also, so we don't have to do a ton of sharing. That first link I just put in there is the link to the chart setup. And when you open that, it's probably going to open with a black background. If it does, we can change that pretty quickly. I'll show you how real quick. That way it'll be recorded. Go in here to the little gear right next to where the little D sign. This is on, oh, by the way, this is on a daily. These are on daily charts. That's what you want to watch for. You don't want to do it on a 1 minute, 5 minute, or any of that stuff. And you're not day trading them or trying to scalp them. So, a 1 minute chart is essentially worthless for this. It's on a daily chart. Right next to the D, you'll see a little gear in Thinkorswim. Click on that gear, okay? Because if it comes up as a black background, well, let me start over and show you how to actually launch it. Okay, let's go out of there. If you'll go up here to the link I just shared in the room, if you'll copy that link, copy it, okay? If you try to click on it and launch it, it may not launch. Thinkorswim's gotten kind of strange about that lately. Oh, it did come up as white? Good. If you'll go to the very top right of your main Thinkorswim page and click on Setup, there's a little gear. If you look at the red X that X's you out, there's a Setup tab about 3 things over to the left of it. If you click on that and go to the second one down and click on Open Shared Item, take the link that I put in the room and copy it into that box and then hit Launch. It will launch it in a separate window, okay? Once it has launched it in a separate window, go into that window and click on Studies, the tab at the top right called Studies, and click Save Study Set. Okay? In this particular case, I called it my Stock Charts Pin Chart Match. It matches the stock charts that I used to use. Go in there and save it, because if you do not save it, you're going to lose it. Okay? Then granted, you can always go back and watch the video and get it again. If it comes up, I tested it, and mine actually came up black. If it comes up black for you with a black background, obviously that's not going to work, because all the indicators on the lower end of this thing are black, so they're all going to be blended in there. So if you'll click on the little gear next to the D that shows it's on a daily chart, and then click on the Appearance tab, it's going to be right in the middle up at the top, and then click on the Common tab. Okay, when that opens up on the left side here, click on the tab that says Common, and go on down to where it says Background, and switch your background to white. It's going to give you all the colors you want. Switch that thing to white. Hit OK. I'm not going to hit OK because I don't want to change it. Hit OK, hit OK, OK 2 or 3 times and get out of there, and then all of a sudden, boom, your background's going to show up white and everything's going to look just like mine. So what I've done here, by sharing that link, that allows me to give you guys this exact same chart setup as what I developed without having to do any work. You got to link it and open it. Okay, that's the first thing. Let me know if anybody gets stuck there. I'm going to go to the scanner next, because I'm going to give you that also. All right, so here we go on the scanner. Let me get that link. Here's the scanner, share scan query. All right, here's the link for the scanner. Now, the scanner's got a bunch of lines and custom lines in there. As you can see, they're all custom lines, and there were things that, like I said, I developed them so that they are a progressive, of progressive nature, and that an RSI is taking itself a couple, 3 days ago and going from an oversold situation where it's under 30 and progressively fixing itself to where ultimately, for it to correctly show as a pinch trade, it has the RSI greater than 34. That does a couple things. It sets off people's scanners that show up stocks that go from oversold into a neutral zone or a better than oversold zone. That's what that line is doing, those three lines. It's taking it from 3 days ago, 2 days ago, 1 day ago, and today, and it's progressively making things better in the scan so that I can set off other people's scanners on stocks that are real oversold that are fixing themselves. Okay, so by setting up my own scan that way, and for you guys, we're going to be a step ahead of them because when it sets their stuff off, we've already got it. So that's what it does when I talk about a progressive nature in the MACD, in the ADX, and in the RSI. That's what's going on in there. I'm going to copy this next link. If you'll launch this next one in your Thinkorswim, that one's going to give you guys the scanner. All you've got to do is open that one up, launch it, same way, go to the top setup gear, open the I don't remember what they call it, share, what do they call it? Open shared item. Open that shared item. It's going to open a box like this. Copy and paste that little link I just put in the room in there and hit preview. And go up into it on the 3 lines with the dots. There's 2 of them, a setup on the top and a setup on the bottom on the very top right of your page. Go to the setup, the 3 lines and 2 dots on the bottom and hit save scan query. And call it whatever you want. Call it a Moto pinch play scan. This is the part that's going to save you guys countless hours of trying to find these things. Each day, it's going to populate some. Here's the interesting thing. You're going to notice on days that the market does well that a lot of these companies try to follow the bandwagon. You'll get a bunch of them. You'll get 20 or 30 that might show up. Got to drag them all over into your Marketwatch, because they're legitimate pitch plays or they wouldn't be showing up. You can look at each one of them on the chart. Where this stuff works really well is when we get 2 days in a row, like yesterday and the day before, where we had 2 nice green days. Had I started this 3 days ago, I'd have had a bunch of wins already, but I started yesterday. Had I started 3 days ago, I would have been able to take advantage of that big green day, and then yesterday is a green day, and a bunch of these things would have worked. And I'd already be out of a bunch of them, and the little Excel sheet I put down in the documents would be loaded with winners already. And my platform would be loaded probably with ones to short because they'd be at the 20-day. However, I didn't start this till yesterday, so we're working with those variables. So that one I just gave you is your scanner. That should launch the scanner. Run that scanner. It's going to populate stuff for you. Open up the chart. You can detach that chart. If that chart opens up in your main page, you can detach it up on the right. And then all you need to do to create this static Marketwatch that I have is click on your main page on Thinkorswim, click on your main page Marketwatch tab at the top middle. And on the left side, it's going to list all the stuff that you have. In my case here, it's got lists of all the different Marketwatches I've got. Go on down about 3/4 of the way, and it's going to say Create Watch List. Okay, when you click on that, that's going to become what's called a static Marketwatch. It's not going to be a dynamic one that is populating from a list of scan criteria that are being met, and it's putting ticker symbols in that scanner. It's not going to do that. It's going to basically be a dead one. You want to create that, and then that's going to create the one that you have, that you see I have over here on the left. Okay, and then the last thing you want to do is right there where mine says pinch plays, you see the up arrow and the down. On the left side, there's an up arrow and a down arrow. If you click on the box next to it, it's going to give you some colors. Okay, I have all my day-to-day stuff that I day trade, scalp, whatever I do, trade futures, on the red box. Okay, so all that stuff synchronized together. I wanted to separate my pinch play stuff from my daily stuff. While I still look at it daily, I don't want it tied into all the multiple chart setups that I have, because all those chart setups are irrelevant for pinch plays. They're more designed for trading, scalping, futures, options, stuff like that. So they're not going to show me what I want to see. So what I did in there is I selected the yellow box, the number 2, and then go to this white chart and do the same thing. Right next to where you type the ticker symbol in, go in there and select the yellow box there also. And now you're going to have a Marketwatch list that is synchronized with that chart. So, all I have to do is run, like I said, run my scan. I'll go back here to the scan tab. Tomorrow morning I'll hit scan. It's going to take these things and it's going to populate them. I'm going to drag them over into my Marketwatch. They're going to go in there. And then I'm going to put my chart right back up here. I'm going to start at the top here. I'm going to click on it. It's synchronized to my chart. I'm going to take my down arrow and I'm going to go through them. And quickly I can look at every single one of them as you're seeing here real quickly. So tomorrow morning I'll look at those. And it's going to let me look at the new ones. But it's also going to let me look at all the existing ones that I have to see if they're at the 20-day. And if I haven't met my 10% profit, if they're at the 20-day, I'll take whatever profit it's given me, whether it's 3%, 6%, 8%, doesn't matter. I'll take that profit and I'll look at it. I'll look at the stock and say, okay, this thing gapped down, died, it moved sideways, died some more. It's going to fail at the 20, so I'm going to short this thing. So by going through my entire list, it allows me to find the ones that I'm in that I need to get out of. It allows me to look at the new ones and determine if I want to get in. And it allows me to look for ones that are at the 20-day so I can short them. Hang on one second. All right. So, so I can blow through this list really quickly. And it's going to let me see. And it's also, I cleaned this up to there. There was probably about 20 more in here than what there currently is. And it was like that one that I showed you that fell, that didn't work for me, that was in the neutral zone. It didn't look like a good pinch anymore. It wasn't at the 20 to short it, so it's not a play. It's not a play option for me anymore, so I got rid of it. I cleaned probably 20 or 25 of them out of here. Excuse me. Let me answer his question real quick. More sit behind, make a watch list once I run the scan, drag each one. On your main page, I'll open it up. On your main page for Thinkorswim, click on that top Marketwatch tab. And right where you see my little one box with the red thing that we changed to synchronize, go to the left of that. Mine says quotes in it. Click on that. And then scroll down about 3/4 of the way and it'll say create watch list. Okay? It'll open a brand new box that will say new watch list. And in there you can type pinch plays. That's what I call mine because that's what they are. And then you can actually go into there and put a couple tickers that you already know are working and then hit save. Once you save that, it's going to show up like this on your main page. Go to the 3 lines with the 3 dots to the top right, right underneath the X where you'd X out, and click on the top group of 3 lines and 3 dots and go down to detach. Okay? Now if I detach that, I can shrink the size of it and that then becomes my, in this particular case it wasn't my static one, I just attached one of my other ones. But then it's detached and then this is where you'll go to the little link. This one says quotes, and then 2 and up and a down arrow, there's a little link right there. Click on that link, I'd change that to yellow, and now this one would actually be synchronized with my pinch play stuff. I'm going to X that one out because I don't need it. But that's how you get your Marketwatch thing. So you got 3 processes here. You got a scanner that I gave you a link for. Run your scanner in the morning. Let it find the pinch plays. Take the pinch plays, detach and set up a Marketwatch that's static. Take the pinch plays that show up tomorrow and drag them over. If you want to, you can go down into the documents, down in the bottom right, and pull up the ones that I have and enter them into your Marketwatch so you can keep an eye on them and get some practice. Look at those. Watch for the ones that get to the 20 days so you'll know when they're going to fail. And then, you can open up a simulator just about any broker you have, whether it's Interactive Brokers or Thinkorswim or Fidelity, whoever. Set up a platform, a simulator platform, and take the trades on them so that you can practice getting in right, getting in wrong. Here, I'll show you again, JD. Sorry about that. All right, click on the Marketwatch tab. You see where I'm circling right here, where mine says quotes? That's an active box. You can click on that box so that it will let you pick from any of the Marketwatch. I got several of them because I write a lot of stuff for a lot of people. So it'll let you click on any of them. There's my open interest for the weekly pinstrikes. I can run that real quick. Let you guys see what ones are open interest with strikes that should have imbalances. So you can, don't click on any of those. Go down about 3/4 of the way where it says create watch list here. Find it? So click Marketwatch tab. I'm circling the active tab that says quotes in mine. Click on it. Opens up a new box. Tab. I'm circling the active tab that says quotes in mine. Click on it. Opens up a new box. Shows me all my list of Marketwatch things that I have. And then go down to create watch list. Click on it. Give it a name. Call it Pinch Plays. Save it. It's going to be your, actually I'll do that right here. I'll do the same exact thing I want you guys to do. I'm going to go over, say Pinch Plays. There's a copy of the one that I have going on the left over there. There's my Pinch Plays. And I'd go to the 3 little lines with the 3 dots, hit detach. Now I have detached a second one that is identical to the other one sitting there. And then I go to the little link bar. I change it to yellow, and now I have 2 of them that do exactly the same thing. So I'm going to get rid of one of them. So a couple things you could do. Go into the document. There you go. Go into the documents in the form here, bottom right corner. Look at the ones that I put in there that I already have going. Like I said, I made correct entries on them. I made correct exits on the ones that were winners. Correct entries on longs. I made correct entries on shorts. Whether or not they work is yet to be seen. There's a chance that here's the coolest part of all of it. When we get, and I probably should have done this a while back with you guys because we had so many bullish days. We had so many good days. We had a lot of stocks that tanked, you know, and Apple actually pinched. If you look at it, you know, so a lot of good companies they died. You know, DSW died, First Solar died. All these good companies died, but we were in a bullish trend, and a lot of them refixed themselves. So what's cool is if we get green days, a lot of this stuff works. Now, not all of it works. You know, a lot of them are junky companies. Don't forget. A lot of it does work. So when we get green days, and a lot of these work, what's cool is the ones that are at the 20-day still don't work. You can still short them. You know, so you're going to see the First Solars and the companies that everybody's piling on because we're having green market days and they're thinking, you know, these stocks are just going to follow. You're going to see things through a different light. You're going to say, no, that one had 3 days in a row. It's at the 20. It's fixing to die. It's going to be part of it on the short side. So when we get neutral days, slightly green, or really nice green days, that's when it's the funnest to play these because you get to play both sides, and usually they both work. You know, you're playing long positions on the pinch because the pinch is set up correctly, and you get wins out of it. And then when it follows through with another green day, the next day you get wins. You know, if you get 6-8% out of them, but you got 10 of them, you're closing. You actually, you know, you got a lot of money you made. When they get to the 20-day, you don't care what the surrounding market's doing because they fail. You know, most of them. So you take it short. So you're actually kind of playing in your own world where everybody else is doing bandwagoning and following what else is going on. You know, you're not on that. You know, you're not jumping on that same train. So run your scan or put some of mine in there. When you scan in the morning, put it in the Marketwatch, put the chart up, look at them. If you forgot all the criteria that has to be met, watch the video again. You know, watch it a couple times you have to. I know it's long. It hasn't been too long. How long did we do today? Hour and 45 minutes, and I'm done now. All right, any questions that bore y'all? Did you learn anything? Try to teach y'all something that I knew most in here probably would not know. I've been asked to do some options classes. You're welcome. I've been asked to do some option classes, which I'm going to do. I want to do a class on spreads, teach you guys how to do vertical, you know, credit spreads and debit spreads and blah, 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 all that stuff, and butterflies and iron condors. I can do that, but that's all kind of run-of-the-mill stuff, you know, and the question is it working? So when I was asked, hey, can you do a class tonight on either credit spreads or debit spreads or your pinch plays? When it came down to it, I looked at it and I said, I'm going to do something that I know most in there do not know. That's why I chose this. You know, a lot of people know how to do credit spreads. A lot of them don't. And I'll do a class on that stuff for you guys. All right, LC trade you talk about with the weak puts. No, I wish I had. You know, I got caught up in, you know, that's about a 3-day-old play, and I got caught up. I'm real busy at work all the time, and at night I got caught up in putting this program together for tonight. And, you know, so a lot of this kind of stuff doesn't allow me much time to trade. You know, I got to a couple things going. I'm not that excited about them. I feel pretty good about that MU trade. Doggone thing is so overdone. I got that one going on. Let me look at it real quick here. I bought, and I posted in the room. You know, somebody gave me a hard time last week. So you never post any of your stuff in the room. I'm like, really? Come on. I'm like, give me a break. You know, I post it, I spell it out, and I do everything but hold your hand and make the execution of your platform for you. There's the MU chart. There's a couple things in place here. You know, it's got to be getting exhausted. It doesn't have to be, but it would look like it should be. You know, there's got to be some kind of. My thought process was this: it has a lot of open interest, but the open interest is somewhat deceiving. It has 15,000 on 11 strike. However, on a stock that trades 23 million in volume, if you look at the open interest and do the math on it, 15,000 open interest on 11 doesn't even accumulate more than about $1 million in value. So in the big picture, $1 million in open interest as far as an imbalance is probably not an imbalance on a stock like this because of the volume. If this thing traded $1 million, yeah, it'd be different. So I'm not really looking for the imbalance itself to be the biggest driving factor on this thing, in that there's zero on the put side and a little bit on the call side. The dollar value of it is not that high. I'm looking at it as, okay, this thing's had what? 1, 2, 3, 4, 5, 6, 7, 8 days, 8 or 9 days in a row up. Tomorrow's Friday. Monday's a holiday. Tuesday, we don't know what's going to happen tomorrow. How can we possibly know what's going to happen Tuesday? You know, something big could happen over a 3-day weekend. So I look at it as, okay, a little bit of an imbalance. Looks like it should get exhausted. Maybe, you know, I looked at it more of, if I was in this stock long and I got in this $9.75 to $10 range and it was at 12 bucks right now, would I challenge that over a 3-day weekend to see if it goes away Monday or Tuesday morning? And I told myself, no, I wouldn't. And I don't think a lot of other people would either. Now, that's just my opinion. So with that thought process, I thought, okay, for 12 cents, we can play an in-the-money put on it. You know, they're already 5 cents in the money, so really all we have at risk is 7 cents on a 12-cent entry. I don't know what you guys got. I know I got 12. Daryl got 12. A few people got 12. Some of you guys got 13, 14. So we got some things in our favor. We got a put that we're playing that's starting off in the money tomorrow morning already. We got a 12 strike into 11.95 when it closed at. I didn't look at the open hour. I mean, after hours, what it was doing, but we're already 5 of the 12 cents in the money. So with all that intact, I thought it's a relatively safe play. So, you know, granted, we don't go big. Remember, don't go big. Don't do 100 contracts. You know, do 5 contracts, do 6, 8 contracts, whatever. Put 50 bucks in it. You know, because if it drops down to 11.50, 11.75, we'll get a nice win out of it. You know, and that's my objective there. That was my reasoning behind it. So anyway, all right. So there's a trade I'm in for tomorrow. Is that MU trade? I posted it in detail in the room with my reasons why. You guys could get in it too. I don't hoard this stuff to myself. And I don't, you know, I'm a real trader, so I don't mind losing. I don't like losing, but it's part of the game. You know, my wins are way better than my losses, and they always are, and I'm consistent because I'm very disciplined. So if I post some stuff in the room and it don't work, I don't take it personally. You know, because if you're paying attention, listening, playing it small, you don't care either. You know, if we get, let's say we got this 12 cents and we get out for, say we get 25 cents on it tomorrow. We did 5 contracts. You turned 60 bucks into what? Oh, that's late to do math like that. 125 bucks. So 130. It would be 100. What? 150% winner. You know, so you turn 60 into 150 bucks. You know, if we do the next one and we put 40 at it and it doesn't work, who cares? You know, we'll hit one of these big ones again. I've hit some pretty big ones in this room, and we'll hit one again. And when we do, it pays for about 25, 30 of them. Then you won't care anymore. I just know some of you new people need us to hit one of those big ones so that you can get ahead of the game. All right, any questions? I mean, did I leave y'all totally confused? It's recorded, so you're welcome. It'll probably take a day or two. It takes a little while for Omnovia to get these things. Actually, not Omnovia, it's more WebNet. It'll take them a day to process this video. Lloyd will put it up on YouTube, and once it's there, then you guys can access it. And that's it. That's all I got. So I got a question in real quick. I'm going to shut my mic off. I have my own YouTube video channel, and then the forum has one. These, let me think where these end up. I'm pretty sure these end up on the forums or Lloyd's. Somehow because they're, well, it depends on how he names it. If it gets named after me, Motocross Nut 34, it'll end up on my forum also. And if it does, I'll share it with y'all. All right, just looking at VNet, you should mention that on these pinch plays to watch for earnings or dividends. Yes. Good example of that is look at DSW. Let's put that in here. Thank you for mentioning that, Glenn. Look to see if they have earnings coming up, okay? Because a lot of stocks run up to earnings, and then they die after earnings. That's a pretty common procedure that goes on. And DSW was a classic example, but it fixed itself. Not all of them are going to do that. You don't get quite that lucky. So, yeah, I knew you got into it. If you look at DSW, I got it on my chart showing in the room here. It went up 3 days, didn't get across. I wouldn't have taken that because, well, look at it here. Got a decent pinch. For as far as a setup for a pinch, when it was going up into earnings, I don't see anything that would have made me take it because the stock, if you can see my gray line all the way up and down the chart, the pinch was good. However, right where my gray line is on that third candle up, it still hadn't turned the D plus up much, and the stochastic has not crossed yet. And it definitely didn't have, well, it had a higher volume, but nothing to write home about. So I didn't know it had earnings. Obviously, that didn't help it. But it's fixing itself. So here's the interesting part. You guys can keep an eye on this thing. This is DSW, okay? It had 3 days up into earnings. I guess everybody wanted to make it look like, hey, this thing's going to be great on earnings, but it's retail. You know, most of the retail companies are coming in stinking. So, you know, it was a pretty easy play to, if the premiums weren't inflated too high in the options, play the put side because most of the retail people aren't doing very well, especially in this kind of industry. So it gapped down. But interestingly enough, it started to fix itself. So if you wanted to take the time, you could look at this thing and say, okay, how bad did they miss on earnings? What really gapped them down? And if it comes in and they missed on revenues and they missed on earnings and missed on everything and they guided down, then the flip side of that is this increase that went back up the last couple of days is not warranted. It doesn't deserve that. And a gift would be if this thing actually does run up to the 20-day because that's your known foul point. It's going to show up as a pinch. I don't know if I went and read the earnings stuff and found out why it gapped down and they deserved it and they missed on stuff, then it's not, I probably would not play it to the long side even if it set itself up better than it did this last time. I would sit here and wait out to get to that 20-day, and while everybody's piling in it long, I would take a shot at it short when it hits the 20-day because if the gap down is substantiated, then when it gets to the 20-day, it's definitely going to fail. So you know, that's a good one that Glenn brought up. Good comment on the fact that you want to keep an eye on earnings. You can see what happened here. That's a 4-8 moving average. And if you go to about the middle of this page here, it's a momentum chart setup. Like I talked earlier in the video, it's a 4-8. 4-8s cross pretty quickly, but they cross back just as quickly. So from a pinch standpoint, I'm going to play it as a pinch. The 4-8 is going to get people in it because they're going to say, well, on a momentum chart, this thing's got momentum. It just crossed the 4 and the 8. Okay, great. So they're seeing it through rose-colored glasses, and that's all they see. You're seeing it as if you go back a month and a half, it crossed through 4 or 5 times and failed. So great. Let it cross. Maybe play it to the long side, make a little money on it. When it gets to the 20-day, short it or play puts. You guys can play options on these things. If they've got liquid options, you can play them. You know, like I told you, my buddy played it on First Solar. He played it on Gilead Science. Won on both of them. Easy plays. Got a perfect signal when to play and perfect signal when to get out. So, you know, if the thing generates some companies like First Solar and stuff, you can play the options on it, and you got some good knowns. Be a little careful playing to the long side on the options because when these things pinch, even though they work, options premiums are really inflated here lately, and you're going to get really frustrated if you say, "Well, I timed that perfect on the pinch," but if it doesn't have a whole lot of room to get to the 20-day, you can see the stock actually move and your options still die on you. And then you're going to be going, oh, wait a minute. I timed it right on the pinch. The stock went up, but yet I lost money on my options. That can happen because the premiums are inflated, and you got to look at how much room it has to move. You know, if it only has $1 to move and they got $1.50 in the premiums, inflation, you're probably not going to win on that thing. You know, you'd be better off waiting until, you know, like I said on this one, look up the reason why it gapped down and say, okay, that was warranted. That should have gapped down. And the fact that it's going up now is not warranted. I'm just saying this hypothetically. And so wait on, put it on your list, on your Marketwatch list on the left side over there and say, I'm going to wait out to get to the 20-day, and then I'm going to play puts. I'm going to short it. And I'm going to go out a week or two because it's probably going to work. All right. So just commons or options. You can use it on both. Get down there, bracket 2. Yep. All right, so everybody, I'm going to go ahead and kill the mic. I'm going to shut off the recording first here. Let me get rid of that. Appreciate everybody being here. Appreciate everybody being members of the Trade with Joe room. Appreciate what you guys do contribute. A lot of members contribute a lot of valuable information. Pay attention in here, guys. Again, the rules are post your entries, post your exits. This stands true for the moderators also. I was telling Lloyd, I said, I don't like working from the top down. If you're a mod in here, you need to post your entries and exits also, just like we expect from everybody else. It adds value to the room, guys. If you're a member and you say, hey, I just got in this at this, be proud enough to say, hey, I'm proud of my entry and this is where I got in. Here's where I'm going to exit. You know, that adds value. Just saying, hey, this was my win doesn't add any value. So appreciate everybody here, and I appreciate the fact that I moderate other rooms, and this room is really good about that. You guys are pretty on track, and it's really appreciated that you keep that on track like you do, you know, because it adds value and it keeps value here. Yes, where you lose a few members, you gain a few members, but you're always going to have your people that come in here very desperate. They've been in other rooms and they lose, and they're desperate when they get here, and they're thinking, oh goodness, for $17 a month or 30, whatever it costs, you know, I can sit in a room for a month around a bunch of guys and girls and ladies that know how to trade, and they handpick one trade out of maybe 10, and they get the losing one, and they bet the farm on it, and now they're gone. You know, so don't be one of those. You know, fit in, blend in, add value, and just kind of watch. Sit back and watch for a while, see what's going on, kind of see who knows what they're talking about, see who's just blowing hot air, you know. There's some good traders in here. There's definitely some good traders in here. You know, I don't ever recommend following someone. You know, I personally choose to be a leader, and I like to see members all be leaders also. Yeah, and I'm going to go ahead and I've said everything I need to say. It's an hour, 57 minutes. Everybody knows I'm long-winded when I give a class.